Picture this: the world's economy isn't teetering, it's quietly slipping, and not because of headlines or viral memes, but due to forces powerful enough to alter every paycheck, every business plan, and every life. Here's the kicker: while most are playing catch up, a handful of insiders, they can already see the tremors, and today, I'm handing you their playbook. Imagine standing on a calm shoreline. The waves lap gently against the sand, the horizon looks endless, and the world feels steady. But beneath that calm surface, a storm is already forming far out at sea. By the time most people realize it's coming, it's already too late to move. That's exactly where we are right now in the global economy. On the surface, the numbers might look stable, the headlines might sound reassuring, and the average person might think things are just business as usual. But if you know where to look, if you read the signs the insiders watch, you see the cracks forming. And once those cracks widen, the ripple effect won't be gentle, it'll be seismic. The first signal is the sheer weight of debt. For decades, governments, corporations, and households have operated as if borrowing had no limits. It was cheap, it was easy, and it felt harmless. But debt isn't free, it's a chain. And now, with interest rates climbing, the cost of carrying that chain is crushing. Imagine a household that took on more mortgages, more loans, more credit cards when rates were near zero. Now multiply that by entire countries and giant corporations. That's what's happening. Servicing this debt is no longer sustainable, and it's bleeding growth from the inside out. What looks like prosperity on paper is being hollowed out by obligations too big to meet. The second clue is what economists politely call stagflation. But let's call it what it really is: a trap. Prices keep climbing, squeezing families and businesses, but growth keeps slowing. That means you're stuck in the worst of both worlds. The cost of living doesn't ease, and the opportunities to climb the ladder dry up. For policymakers, it's a nightmare. Lower interest rates to stimulate growth, and inflation runs hotter. Raise rates to fight inflation, and you suffocate growth. There's no easy lever to pull, and that's why this storm is different. It's not a one-dimensional problem. Then there's the demographic shift almost nobody talks about outside of think tanks and insider circles. Populations in major economies are aging, workforces are shrinking, pension systems are straining. That doesn't just mean fewer workers paying into the system, it means more people drawing from it. And that imbalance creates structural stress that no short-term stimulus package can fix. It's like a ticking clock. Each year, the problem compounds, and yet it's invisible to most people until it lands on their doorstep. But perhaps the most underestimated shift is in money itself. For nearly a century, the U.S. dollar has been the backbone of global trade. Every transaction, every deal, every reserve leaned on it. But today, that dominance is being tested. Emerging economies are building alternatives, central banks are experimenting with digital currencies, and new technologies are redefining how money moves. To most, this feels abstract. To insiders, it's a revolution already underway. When the foundation of the global financial system wobbles, everything built on top of it shakes. Here's the truth most don't want to hear. This storm won't be announced on your evening news. It won't arrive with fireworks or front-page headlines. It arrives quietly, creeping into markets, boardrooms, and households. By the time the average person feels it, it's already too late to prepare. But those who see it early, those who recognize the signals, are the ones who don't just endure the storm. They position themselves to come out stronger on the other side. The difference between being blindsided and being ready comes down to perspective. Most people look at the surface: stock prices, short-term job numbers, political promises. But the real story is always beneath the surface: unsustainable debt, trapped growth, aging demographics, and shifting currencies. That's the hidden storm, and ignoring it won't make it go away. What matters now isn't fear, it's foresight. The question isn't whether challenges are coming. They are. The question is, will you adapt, retool, and build resilience before the storm hits your shore? Because when it does, those who prepared won't just survive, they'll lead. This is the moment to stop playing the short game, to stop relying on what worked yesterday and start anticipating what tomorrow demands. The insiders already see what's unfolding. The choice is whether you'll be one of the people left scrambling after the fact, or one of the leaders who had the courage to face the storm before it arrived. That storm is real, it's hidden to most but not invisible, and the smartest move you can make is to stop pretending the horizon is calm and start preparing for what's already heading our way. Picture a massive giant standing tall, but its entire weight is balanced on thin, fragile legs of glass. Every step, every move threatens to shatter the ground beneath. That's exactly what our global economy looks like today, built on debt so enormous, so widespread, that the entire system is balancing on shoulders far too fragile to carry it much longer. For years, debt has been treated like a harmless tool, a quick fix, a way to fuel growth without limits. Governments borrowed, corporations borrowed, families borrowed. It was encouraged, celebrated, normalized. But debt is not growth. It's an obligation, a weight, and right now that weight is testing the very structure of the global economy. Think about the environment we've been living in for the last decade. Interest rates sat near zero, money was cheap, and borrowing was easy. Politicians promised prosperity, businesses expanded recklessly, households lived lifestyles far beyond their means. Why? Because borrowing felt painless. You could refinance, roll it over, kick the can down the road, but here's the catch: cheap money was never going to last forever. And now, with rates climbing, the real cost of that debt is being revealed. Servicing these obligations is draining resources that should have gone to innovation, growth, and opportunity. Instead of fueling the future, capital is being swallowed by the past. Governments are the most obvious example. Many are drowning in deficits, piling on trillions as if numbers don't matter. But numbers always matter. Debt doesn't vanish, it compounds. When interest rates were low, those payments felt like pocket change. Now, with rates surging, governments are spending more just to service interest than they are on schools, healthcare, or infrastructure. That's not strategy, it's a slow suffocation. And when governments can't deliver services without sinking deeper into debt, faith in leadership erodes, markets grow nervous, and citizens lose trust. Corporations aren't much different. For years, companies borrowed heavily to buy back stock, inflate valuations, and chase short-term gains. Investors cheered, executives pocketed bonuses, but the foundation was hollow. Now, refinancing that debt is no longer cheap. Margins are tightening, costs are rising, and companies that looked bulletproof a few years ago suddenly look fragile. When the cost of servicing debt exceeds the profits a company makes, the math doesn't lie, it's a countdown to collapse. And then there's the household level, the part nobody likes to admit. Families have been told for decades that debt is normal. Student loans, car loans, credit cards, mortgages. It became the default way of life, and in times of low interest, it seemed manageable. But when rates rise, when inflation eats into every paycheck, when wages don't keep pace, suddenly those monthly payments aren't just numbers, they're chains. Families are cutting back, delaying dreams, feeling the squeeze. And when millions of households are squeezed at once, consumer spending, the engine of most economies, slows down. That's when recession becomes reality. Here's the uncomfortable truth: debt isn't just an economic figure, it's psychology. When people, businesses, and governments live under crushing obligations, their decisions change. They play defense instead of offense. They avoid risk, they stop innovating, they hunker down. Progress stalls, and the system starts to feed on itself. Less growth means more borrowing to survive. More borrowing means higher costs. Higher costs mean even less growth. That cycle doesn't end well. Some will say debt can always be managed, always be restructured, always be refinanced. But history disagrees. Every empire, every nation, every system that drowned in unpayable debt eventually faced the breaking point. Whether through inflation, default, or collapse, the math always catches up. We're not immune just because we're modern or advanced or connected. If anything, our interconnectedness makes the risk bigger. When one domino falls, the entire chain trembles. The question isn't whether debt is dangerous. The question is how long we can pretend it isn't. Right now, the giant still stands, but its shoulders are cracking, its legs are fragile, and every new dollar of borrowing adds weight to a structure already groaning under pressure. The insiders see it, the markets whisper it, and soon everyone will feel it. What separates those who get crushed from those who rise is preparation. You can't wish debt away, but you can adapt to the reality it creates. You can build strategies that don't depend on endless cheap credit. You can shift from chasing illusions to building resilience, because the truth is, the giant may fall, and when it does, those who relied on its strength will be buried, but those who built their own foundation will be the ones who step forward and lead. Debt isn't just a number, it's a warning. And the time to take it seriously is not when the collapse happens, but right now, when there's still a chance to move before the ground shatters. Imagine walking into a room where the walls are closing in. On one side, the pressure of rising prices. On the other side, the drag of slowing growth. No matter which direction you turn, you're trapped. That's the reality we're stepping into right now. Stagflation. It's not just an economic buzzword. It's one of the most dangerous combinations any society can face. And it's creeping back into our lives with a force most people don't see coming. For decades, the world operated on a simple playbook. If growth slowed, central banks cut interest rates to spark spending. If inflation spiked, they raised rates to cool things off. It was a balancing act, but at least there were tools. Stagflation changes the game. It creates a no-win scenario. Growth weakens, jobs become fragile, businesses hesitate, but at the same time, prices for essentials, food, energy, housing, keep climbing. You can't fix one without making the other worse. Lower rates to stimulate the economy and inflation skyrockets. Raise rates to fight inflation and the economy stalls even harder. That's why insiders fear it more than almost anything else. It's not a simple storm you ride out. It's a trap. The signs are already here. Look at the cost of living. Families are paying more for groceries, fuel, rent, and healthcare. These aren't luxuries. They're the basics of life. When the essentials rise faster than wages, every household feels the squeeze. People cut back on discretionary spending, which hits businesses. Businesses then slow hiring, delay expansion, and reduce investment. That slowdown feeds right back into weaker growth, while inflation doesn't ease because the supply side, energy shortages, broken supply chains, and geopolitical conflicts, keeps pushing prices up. This isn't temporary, it's structural. History gives us a preview. The 1970s were defined by stagflation, oil shocks, rising unemployment, and relentless inflation. Back then, central banks had to push interest rates to painful heights to break inflation's back, plunging economies into recession before they could recover. People lost jobs, businesses collapsed, and markets were volatile for years. The danger today is that we're repeating the same setup, but on a much larger, more interconnected scale. The global economy is far bigger, the debts are far higher, and the expectations of stability are much greater. That means the shock could be even more destabilizing. For businesses, stagflation is a nightmare scenario. Costs rise, materials, wages, energy, but customers are less willing to spend, margins collapse. Companies can't simply raise prices forever because demand weakens. At the same time, borrowing to cover shortfalls becomes more expensive because interest rates are high. It's a pincer movement squeezed from both sides. That's when once stable companies suddenly announce layoffs, restructuring, or even bankruptcies. For individuals, the effects are just as brutal. Inflation eats away at savings. A dollar saved yesterday buys less tomorrow. Paychecks stretch thinner, debt payments climb, and opportunities dry up. The dream of building wealth, buying a home, or planning for retirement feels more distant. It's not just numbers, it's people's lives. Stagflation erodes not only financial stability, but also confidence. And when confidence goes, markets tumble and fear takes over. What makes stagflation especially sneaky is that it doesn't announce itself loudly at first. It arrives in whispers, slightly higher prices at the grocery store, a few industries slowing down, central banks hesitating on policy. Then, before most people realize, the squeeze is everywhere, and because there's no easy fix, it lingers. That's the part most people underestimate. Recessions come and go. Inflation spikes and fades, but stagflation sticks. It grinds economies down over time, wearing people out, draining hope. But here's the reality that separates leaders from spectators. A trap doesn't mean hopelessness. It means strategy matters more than ever. If you understand the dynamics, you can adapt. For households, that means cutting reliance on debt, protecting income streams, and focusing spending on what holds value. For businesses, it means doubling down on efficiency, finding resilience in supply chains, and preparing for long-term volatility instead of chasing short-term gains. For investors, it means being selective, seeking assets that withstand inflation while avoiding those dependent on cheap growth. The key is not to wait until stagflation is obvious. By then, the room has already closed in. The advantage belongs to those who recognize the pattern early and make moves while others are still debating whether it's real. Because make no mistake, it is real, it's here, and it's building. The return of stagflation is the reminder that easy solutions are gone. The era of cheap money, endless growth, and painless fixes is over. We're in a new chapter where complexity rules, and only those willing to adapt, innovate, and confront reality head on will thrive. Most will look back and say they never saw it coming, but you don't have to be most. You can see the trap for what it is and step into the future prepared. Look closely at the clock that no one wants to talk about. It doesn't tick loudly, it doesn't flash on screens, and it doesn't grab headlines. But it's there, steady, relentless, counting down. That clock is demographics, the structure of populations, how many people are young, how many are old, how many are working, and how many are dependent, is one of the most powerful forces shaping the future of economies. And right now, it's a time bomb quietly preparing to go off. For years, growth has been fueled by expanding workforces. More people entering the labor market meant more productivity, more innovation, more consumption, and ultimately more prosperity. Nations thrived when their populations were young, ambitious, and expanding. But that era is fading. Across major economies, Europe, Japan, China, even the United States, birth rates are falling, populations are aging, and the balance is shifting. Fewer workers are supporting more retirees, and the math behind that equation is brutal. Take a moment to picture the foundation of an economy like a pyramid. At the base, you have the young and the working age population fueling labor, taxes, and consumption. At the top, you have the elderly drawing pensions, health care, and support. For decades, the pyramid worked because the base was wide. But now, the pyramid is flipping. The base is narrowing as birth rates collapse, while the top grows heavier with aging populations. That imbalance isn't just a demographic curiosity, it's a structural crisis. Governments promised social safety nets when populations were booming, never imagining the future where there wouldn't be enough workers to fund them. Pension systems, health care programs, and retirement plans were all built on the assumption that tomorrow's workers would always outnumber today's retirees. But that assumption has been shattered. In Japan, entire regions are shrinking, schools are closing, and more adult diapers are sold than baby diapers. China, once thought unstoppable, is now facing a declining population years earlier than expected, threatening its entire growth model. Europe is grappling with the same reality, shrinking workforces and ballooning welfare costs, and the United States isn't immune. Immigration has slowed, birth rates have fallen, and the baby boomer generation is retiring at record speed. Every year, millions more leave the workforce and start drawing from Social Security and Medicare, while fewer young workers enter to replace them. That imbalance strains budgets, raises deficits, and forces governments into impossible choices. Cut benefits, raise taxes, or borrow even more. None of those options inspire confidence. For businesses, the demographic time bomb is equally dangerous. A shrinking workforce means labor shortages, higher wage pressures, and rising costs. At the same time, a larger elderly population shifts consumer demand. Spending patterns change, less on housing and new goods, more on healthcare and services. Companies that don't adapt to these shifts will find themselves irrelevant, while those that anticipate them will capture the new reality. But demographics are more than economics. They're also about power. Countries with younger, growing populations hold advantages in innovation, military strength, and cultural influence. Countries with aging, shrinking populations lose dynamism, struggle to adapt, and often turn inward. Global competition isn't just about technology or trade deals, it's about people, and when the balance tilts, so does the future of influence. Here's what makes this time bomb so dangerous: it doesn't explode all at once. It creeps year by year, a little more pressure builds. Pension funds strain, healthcare costs rise, labor pools shrink. Politicians avoid the hard conversations because demographics aren't a 4-year problem, they're a 50-year problem. And so the clock keeps ticking while leaders kick the can down the road. By the time the consequences are undeniable, the solutions are far more painful, but recognizing the problem early is power. For individuals, it means preparing differently for retirement, not relying solely on government promises that may not hold. For businesses, it means realigning strategies to serve aging populations while finding ways to attract scarce talent. For investors, it means spotting industries that will thrive in this environment: health care, automation, robotics, elder services, and avoiding those that depend on ever-growing populations. The demographic shift is not a forecast, it's a certainty. Birth rates are measurable, life expectancy is trackable, and the data leaves no room for debate. The only question is how prepared we are for the world that emerges when the clock strikes. Will we adapt to new realities, or will we let the weight of the time bomb crush unprepared systems? The truth is, demographics don't negotiate. They don't care about policies, politics, or promises. They march forward with unstoppable force. And the leaders who acknowledge that, who prepare for the ticking clock, are the ones who will not just survive the demographic storm, but turn it into an advantage. The rest will be caught off guard, wondering why the world suddenly shifted beneath their feet. The time bomb is ticking. The only question left is whose listening money has always been more than paper, more than coins, more than numbers on a screen. It's trust. It's the glue that holds economies together, the language through which nations trade, businesses grow, and individuals save for their future. But what happens when that trust begins to shift? What happens when the very foundation of money, the system we've all taken for granted, is no longer as stable, as dominant, or as universal as it once was? That's the revolution quietly unfolding right now. A currency upheaval that insiders can already see, while the rest of the world keeps pretending nothing's changing. For nearly a century, the U.S. dollar has been the anchor of global finance. Oil, trade, commodities, debt, all denominated in dollars. It became the world's reserve currency, giving the United States unmatched influence and stability. Nations held their reserves in dollars, businesses settled deals in dollars, and investors trusted it above all else. But dominance breeds complacency, and nothing lasts forever. Today, cracks are forming. Central banks around the world are quietly diversifying away from the dollar, building reserves in other currencies, and experimenting with alternatives. It's not loud, it's not dramatic, but it's steady. And steady shifts in currency power eventually create earthquakes. One of the forces driving this upheaval is geopolitics. Rival nations no longer want to be bound by the dollar system, vulnerable to sanctions, or dependent on U.S. monetary policy. They're forming trade agreements in their own currencies, reducing exposure to the dollar step by step. At the same time, digital technologies are opening doors to entirely new forms of money. Central bank digital currencies, CBDCs, are being developed and tested across the globe. China has already launched its digital yuan. Europe is exploring its digital euro. Even the US is studying its own version. These aren't just gimmicks. They're potential replacements for the system we've lived under for generations. Then there's the rise of decentralized money, cryptocurrencies. While volatile, they've proven one undeniable point. People are willing to trust alternatives outside of traditional banking systems. Bitcoin, Ethereum, and others may not replace fiat currencies tomorrow, but they've sparked a conversation that can't be silenced. They've forced central banks and governments to innovate, to rethink, and to prepare for a world where money isn't controlled the way it used to be. For businesses, this revolution creates both risk and opportunity. Risk because currency volatility can eat into profits, destabilize trade, and complicate financial planning. Imagine running a company dependent on international trade, and suddenly the rules of settlement, the value of reserves, and the speed of transactions all change. But opportunity, because those who adapt to new systems early can gain massive advantages. Companies that embrace digital transactions, that understand cross-border settlement in multiple currencies, will move faster and more efficiently than competitors stuck in old systems. For individuals, the impact is just as real. Inflation eats away at savings when trust in currency weakens. Holding wealth in a single denomination is no longer the safe bet it once seemed. The question becomes, how do you protect your money in a world where the definition of money itself is shifting? The answer lies in diversification, in understanding that the old rulebook no longer guarantees security. This upheaval isn't a Hollywood-style collapse. It's not the sudden fall of the dollar overnight. It's gradual, subtle, like a tide that shifts a coastline over years until one day you wake up and the land looks nothing like it used to. And by the time most people realize it, the shift has already happened. That's why insiders pay attention not to headlines but to quiet move. Central banks reducing dollar reserves, nations experimenting with digital settlements, trade agreements cutting out the dollar altogether. Each step alone seems minor. Together, they signal transformation. History teaches us that currency power is never permanent. The British pound once ruled the world before ceding ground to the dollar. Before that, it was the Dutch guilder, the Spanish real, and others. Each time, the world adjusted. Each time, those who anticipated the shift protected their wealth and influence, while those who clung to the past suffered. We're standing at the beginning of another such moment. The question is whether we'll see it for what it is. The quiet revolution of money is not just about finance, it's about power. It's about who writes the rules of global trade, who controls access to capital, who dictates stability. And when that power shifts, it affects everything: investments, savings, governments, even the balance of global leadership. The future of money is being rewritten, and pretending the old system is eternal is the most dangerous mindset of all. This is not the time to be passive, not the time to assume the tide will turn back. This is the moment to prepare, to diversify, to adapt, because when trust moves, money moves, and when money moves, the world moves with it. The revolution is quiet, but it is real. And those who hear it now will be the ones who thrive when the rest of the world finally wakes up. Leadership means looking through the noise and seeing the tectonic shifts. Today, you don't just get clarity, you get the power to pivot before your competitors do, to retool your investments, your business model, your mindset. We are not spectators in this crisis. We are architects of your next move. Choose clarity over comfort. This isn't a warning. It's your invitation to lead, and that begins now.